Section 9, Loan Types, Terms and Issues. Unit 1, Types of Loans. Unit 2, Private Mortgage Insurance and Participation Agreements. Unit 3, Subprime and Predatory Lending. Unit 4, Tax Impacts in Mortgage Lending. Unit 5, Pity Workshop. Unit 1, Types of Loans. Introduction and Objectives. Lesson 1, Conventional versus Government Loans. Lesson 2, Common Buyer Financing. Lesson 3, Review of Fixed/Adjustable Rate Notes. Lesson 4, Creative Buyer Financing. Lesson 5, Equity-Related Financing. Equity loans versus HELOCs versus reverse mortgages. Home equity loan. A home equity loan is made based on the amount of equity the homeowners have in their home. Loan funds, which are received in one lump sum, are frequently used for home renovations, to fund a college education, to pay off credit card debt, or for other major purchases and expenses. Home equity loans are a type of junior financing, which means they're subordinate to the first mortgage, and higher risk means higher interest rates. The amount received is limited to the combined loan-to-value (CLTV) ratio of the first mortgage plus the equity loan. Most often this is 90% to 95%. Home Equity Line of Credit, HELOC. A home equity line of credit, HELOC, also uses the equity homeowners have in their property. However, because of how it's set up, as a line of credit, homeowners use this as an open-end account. In this way, a HELOC is similar to the revolving credit of a credit card from which the homeowner can take advances, repay money, and even borrow money again. Specific criteria that vary by lender apply to equity loans and HELOCs. In general, here are a few. The draw period is generally 10 to 20 years. The maximum loan-to-value ratio can be as high as 90 to 95%, and in many cases may be as low as 80%. Closing costs may apply. An appraisal is often required. No interest is paid until funds are drawn on the loan. One significant difference between an equity loan and some HELOCs is whether the interest rate is fixed. While the rates on an equity loan are usually fixed, HELOC rates are often variable, ARMs. Reverse mortgage. Reverse mortgage loans allow older homeowners, typically 62 and older, to convert home equity into available funds. The home itself is pledged as collateral for the loan and the borrower typically receives the loan funds in one of three ways. Regular monthly advance payments to the borrower, until the approved balance has been achieved. A lump sum payment at the beginning of the loan. A line of credit for the approved balance that may be drawn upon as the borrower desires. FHA Home Equity Conversion Mortgage, HECM. FHA reverse mortgages are secured by owner-occupied residential property, including residential properties with at least one and no more than 4 units provided the borrower lives in one unit. Fixed-rate HECM loans are available if the borrower receives a lump sum at the beginning of the loan. If borrowers prefer to receive monthly payments or a line of credit, the rate will be adjustable. Because it is an FHA loan, a mortgage insurance premium is charged. Reverse annuity mortgage, RAM. A term that is sometimes used in conjunction with reverse mortgages is reverse annuity mortgage, RAM, in which borrowers use the equity in their homes to stay in their homes. A major criterion of a RAM is that the lender makes payments to the homeowner for a specified period of time and gains corresponding ownership. Creative buyer financing. Short-term loans. Bridge loan, swing loan. A temporary, usually 90-day, loan that provides funds in addition to an existing loan until permanent financing can be obtained. Often used for buyers who have not yet sold their current property but want to purchase a new property. Best used when the buyer's current home is already under contract. Construction mortgage. Temporary financing for construction purposes. The developer submits plans for a proposed project, and the lender makes a loan based on the value of the appraisal of the property plus the construction plans. The entire loan is not given at once, disbursements are made at intervals as phases of construction are completed. Upon completion, the lender makes a final inspection, closes the construction loan, and converts the loan into permanent, long-term financing. Owner-financed loans. Lease with option to buy. The buyer and seller negotiate a sale price that's written into the lease. Sellers will often apply a portion of the rent toward the purchase price. Purchase money mortgage, PMM. The seller carries a portion, or sometimes all, of the loan for the buyer. Wraparound mortgage. The seller acquires financing that wraps the new buyer's mortgage around the seller's existing mortgage. The seller continues to make payments on the first mortgage, and the buyer makes the payments to the seller on the wraparound mortgage. Commercial loans. Blanket mortgage. Used in commercial applications. 2 or more properties are pledged as security for repayment of the loan. A release clause allows parcels to be removed from the lien following a given event, usually when the loan balance lowers to a specified amount. Package mortgage. A mortgage in which personal property is included with the real property in the sale. This might be used in the case of a furnished condominium, for instance, but it is more commonly used in commercial real estate where business assets are included as collateral. Fixed/adjustable rate note. LIBOR 1-year index, as published in the Wall Street Journal, rate caps. 1. Borrower's promise to pay. This is the borrower's certification of payment terms and promise to pay. 2. Interest. This is a statement of the interest rate. 3. Payments. This is the borrower's promise to make payments based upon the amount and schedule set forth here. 4. Adjustable interest rate and monthly payment changes. A. Change dates. This is the date the interest rate will change. 4. Adjustable interest rate and monthly payment changes. B. The index. The explains the index in LIBOR. 4. Adjustable interest rate and monthly payment changes. C. Calculation of changes. D. Limits on interest rate changes. E. Effective date of changes. F. Notice of changes. This explains rate changes, what they will be, and when they will happen. 5. Borrower's right to prepay. This details prepayment options. 7. Borrower's failure to pay as required. This details what happens if the borrower doesn't pay. Why an ARM changes. An adjustable rate mortgage, ARM, originates at a specific interest rate, but that rate fluctuates during the loan's term, based on a specific economic indicator, such as the index of the London Interbank Offered Rate, LIBOR, or the U.S. Treasury rate. The interest rate changes mean the mortgage payments also fluctuate accordingly. Keep in mind that the lender has nothing to do with the rate itself. The lender may set an introductory rate as outlined below, and will set the terms of the mortgage including when the rate adjusts. But the rate itself is tied to the broader economic indicator. Why an ARM? What attracts someone to the potential ups and downs of an ARM? Sometimes, an ARM offers an interest rate that is, for a certain period of time, typically from 3 to 10 years, lower than that of a fixed-rate loan. However, as soon as that initial time period has passed, the ARM adjusts to its fully indexed rate, the margin plus the index. The mortgage note will contain the applicable details regarding how and when, and most importantly to many people, how much the interest rate will change. Most ARMs include a feature that allows borrowers to convert the loan to a fixed-rate loan during a specific period of the mortgage. This is known as a convertible feature. ARM rate examples. Here is one example of an ARM's rates. Initial rate, 5%. Margin, 2.25, won't change. Index, 4.75, can go up or down. To find out what the fully indexed interest rate will be each month, simply add the margin to the associated index. Conventional and government loans. As you've learned, the primary mortgage market is made up of commercial banks, credit unions, and other institutions that lend directly to the consumer. These primary lenders generate the loans, then package and sell them on the secondary market. Loans made on the primary market can be either conventional loans or government loans. Conventional loans. Conventional lenders offer a broad range of loan products that vary in length and carry terms that do not include any insurance or guarantee from a federal agency. Rarely, originators will hold on to and service a conventional loan from start to finish. Usually, though, conventional loans are bundled together and sold on the secondary mortgage market. At one time, buyers had to make up to a 20 to 25% down payment to qualify for a conventional loan. In today's market, few buyers come to the transaction with that kind of money saved. Buyers may get a conventional mortgage for as little as 3% down. This smaller down payment may mean that the lender will require private mortgage insurance, PMI. PMI covers the lender for the difference between the buyer's actual down payment and what the lender would like to see in case the buyer defaults. Some mortgage programs permit a lower down payment with no required mortgage insurance. These programs may carry higher interest rates, though, so buyers must compare monthly payment amounts, interest rates, and total cost over the life of the loan. Conforming versus non-conforming loans. Conventional loans are called conforming when they meet Fannie Mae and Freddie Mac guidelines. Both Fannie Mae, the Federal National Mortgage Association, or FNMA, and Freddie Mac, the Federal Home Loan Mortgage Corporation, or FHLMC, are government-sponsored enterprises, GSEs. During the financial crisis of 2007 and 2008, the federal government stepped in to keep these corporations afloat. So while they're not owned by the government, they're backed by the federal government to protect them against failure. Even though the government has established some controls over Fannie Mae and Freddie Mac, they're still publicly traded companies. Fannie Mae and Freddie Mac work with both the primary and secondary markets, but mostly operate within the secondary market, acting as a sort of link between banks, the government, and Wall Street. They buy thousands of mortgages from banks and other lenders, repackage them into mortgage-backed securities, then sell them on the secondary market. By purchasing loans from primary lenders, those lenders are then able to take that money and make more loans. Loans that don't meet Fannie Mae or Freddie Mac guidelines are called non-conforming loans. Because the loans don't conform to FNMA or FHLMC guidelines, lenders typically carry a higher risk and make up for it by charging higher interest rates. Government loans. Government loans include participation from a federal agency as an insuring or guaranteeing party. The two most common types of government loans are Federal Housing Administration, FHA, insured in U.S. Department of Veterans Affairs, VA, guaranteed loans. Other government loans include loans provided by the U.S. Department of Agriculture, USDA, or through state or local homebuyer programs. A buyer can put down as little as 3.5% for an FHA loan, and VA loans don't require a down payment or mortgage insurance, plus there's no prepayment penalty. The reason lenders don't mind the lower down payment is that the gap in the down payment is covered by the governmental entity. It's either insured by the FHA or guaranteed by the VA. Not having to plunk down tens of thousands of dollars makes government loans attractive to a lot of buyers, especially first-time homebuyers, who won't have equity from a previous home to access. Borrowers with lower credit scores, minimum 580, may qualify for an FHA loan when they wouldn't qualify for a conventional or VA loan, for which a lender may require a score of at least 620. Because of the ultra-low down payment and lower credit requirements with FHA loans, and therefore the increased risk to the lender and the FHA buyers have to pay a mortgage insurance premium, MIP, which is similar to PMI, but unique to FHA loans. A word about mortgage insurance. The primary difference between the mortgage insurance for a conventional loan versus an FHA loan is that the borrower pays MIP for the entire life of the FHA loan. PMI on a conventional loan can be eliminated when the value of the property reaches at least 80% of the loan balance. This occurs when the borrower is unable to put less than 20% down payment, or when the loan reaches its midlife point. Borrowers must carefully weigh the differences between loan products, including the cost of mortgage insurance over the loan's life, when evaluating which loan product is best for them.